All right, traders. Excuse me. This is Blake Morrow. You were listening to the Morning Edge webinar, and I hope everybody's having a great trading session. Happy Wednesday on this January 13th of 2016. We have some special guests that are joining us this morning. We have Chris Baer from Brazil, and we have Ed Matz of London, and myself of Phoenix, Arizona, or Scottsdale, Arizona, rather. But which isn't that exciting, but anyway, I'm glad you all could be here today. We're going to actually be discussing the crude oil and the massive move that we've seen in crude recently, and the U.S. dollar Canadian. Also, we'll be discussing probably other currencies alongside that. So what I'm going to do right now is I'm going to find these two guys in the audience, and let me grab them really quick. So first up, since his name came up first, here is Chris Baer. Good morning, Chris. Can you hear me?
Hi, good morning, Blake. Good morning,
Hey,
everybody.
good morning. I had to bring you on first so we can give Ed a proper welcome. And here is Ed. Good morning, Ed Matz.
Blake, hi, how are you?
Hey, I'm doing well. Don't worry about Chris. He's not even here. Just kidding.
Oh, that's good because look, I just came across something. I thought you might like to listen to it.
Oh, let's hear it.
Can you hear me?
Yes.
I've been practicing that one overnight.
Oh, it's the Three Amigos tune. Chris, are you there?
Yeah,
That's great. I told Ed, I was going to play it, but I don't have any way of doing a playback when the way GoToWebinar works. It's like I can't run an internal like sound bite and have it sound good. But that's really cool you did that, Ed. So how are you guys doing today, Ed? How are you doing over there, Chris? How are you doing in Brazil?
Yeah, everything's fine here. Everything's great. I'm just sitting here having a glass of coconut water from the yard and enjoying life.
Now, Ed, I don't know how accessible coconut water is for you. I mean, we get it in our grocery store, but getting coconut water from your backyard, I mean, that's pretty cool, I'd have to say.
No, I've got no coconut trees growing out at the moment, but we're working. Actually, it's funny you say that. I do use coconut quite a bit for tourism. My daughter loves coconut, so I'd recommend coconut cake. If you use mascarpone and everything else like that, I'm not a bit of a chef at all, or cook, but I do cook because I like it and have to. The other thing, so we're very big on curries over here, Indian curries particularly, and they use a lot of coconut milk. And chicken korma would be a prime, well-known example. So. Yeah, we're kind of familiar with coconuts. We just can't grow the damn things. Probably just as well because someone will probably throw it through my window.
Well, speaking of cooking up some good grub, I mean, because I know you were doing some Brazilian barbecue over there in London of all places. But hopefully, how'd that turn out?
Oh, really well. We found some great dishes. One was, I don't think it's particularly Brazilian, but I found it as a Brazilian, was coriander chicken and lemon, which was you just barbecue it without any oil. It's really healthy, but it's lovely. And the other one was, Chris helped me here, it's got beans, it's like a cassoulet, a Brazilian cassoulet. It's got beans, bacon, sausage.
Feijoada.
Wow. I don't even...
It's great. And the other thing was this Brazilian salad you told me about, and the not the Mai Tais, the cocktails, but yeah, they were.
Well, that's awesome. That sounds phenomenal. Even though it's 6 o'clock in the morning here, the Mai Tais especially sound great. From where I sit.
They weren't Mai Tais. What were they? Come on, what's the big cocktail?
Caipirinha and caipirosca.
Yeah, and made with
vodka or cachaça.
Cachaça, that's it.
And see, now
so expensive over here. How much is it a bottle in Brazil?
Oh man, it's cheap. It's cheap as, and you know something? A lot of people don't know this, but cachaça is not worldwide popularity like other drinks. So there's a lot of upside if Brazil ever got their
If they ever got their economy together, huh?
They ever got? I was gonna say, but I can't say that word.
I know you were going to, and then we're going to keep this a PG show.
If they ever got their act together.
It's like a Bacardi, though, isn't it? Really?
Yeah. Yeah.
Oh, okay. Well,
so listen, I had another recipe I wanted to talk about. There was a
it had to do with crude oil, doesn't it? And the Canadian.
Yeah.
Little concoction. Okay, so let's go in that direction. So let's first of all let's talk about Ed. I know you wanted to come on and really talk about crude and where it's at and how the Canadian would respond, and I think we all have our opinions, and I mean this could be a very lengthy and probably fairly heated debate and about opinions on where crude and Canadian's going. But
I don't think it is, because I think we all agree. I mean, that's it in a nutshell.
Okay, let's
everyone has the same opinion on oil. I mean, that may sound a bit stupid because clearly they don't, but they do. Everyone believes that oil will find a bottom at some point and rally, and the world will be saved. But there are reasons why it might go lower in the shorter term. Define your shorter term, and then the question is how low. Well, how low? The people joking. In fact, it's really good that people are starting to joke, because I love that as a sentiment indicator. But anyway, that's beside the point. So people, now we're close to we're 32 trading at the moment. We haven't been below 30 yet. And so, yeah, let's buy it. And, if you bought a 100 in oil and it went down to 95, you're out 5%. If you buy 32 and it goes to 27, you're out 16, 17%. There's a big difference down here, 5 big figures. So, and that's the difference. It's not the view, it's how you trade the pick. I mean, that's, you're talking substantial risk on a move overnight. Well, we've been in 2016. Where did it start in 2016? We're down massive, aren't we? How much are we down? Around 48. We're down 25%. Yeah.
Yeah.
That's the big. I mean, so euro dollar down 25 big figures. Yeah, really. That's the scale move we're talking about. So it's quite important. So if there was ever a market, ever a time to differentiate a trade and a view, it's now.
Okay. So with crude oil down, like just you're talking about just 2016, we're down 20% already just to kick off the new year, and you're saying that we may not have found a near-term bottom here around $30. I know a lot of people are everybody's trying to pick a bottom, but we may not have found it.
Well, this is when there's. Can I share a screen? Well, you probably saw me tweet something yesterday about Paul Tudor Jones.
Let me give you. Let me make you a presenter so you can actually. You ready?
Oh,
it's coming over.
Oh, do I get a badge for that, or
you do? You get a little shiny star. Here it comes. All right.
There you go. You
get a little strawberry shortcake.
See, play 3 more goes again.
Oh, there it is. Oh, Paul Tudor Jones.
Yeah, I tweeted this because he's my hero is the wrong word. Not my mentor.
Someone you respect very much, his approach to trading.
Thank you, Chris. Yeah, I'll just open my mouth and you fill the gap, please.
I'm sorry, Ed. I hope I caught that. Did I catch it right?
Yeah, no, you absolutely nailed it. It was just right there's me stumbling for the words. Right, basically, he says that everyone says, and you'll love this, Chris. Trend is your friend. You make all the money you make in the meat of the move, and forget about trying to pick a bottom or a top, because you'll get killed, and that's the way you not make money. He's saying the money he's made, the serious money he's made, he's missed the meat in the middle. He makes money tops and bottoms, and he says as a wind-up, that's probably a separate time, I can't remember, but it's a phrase I've used a lot because it sums it up in some ways. If you're going to trade those type of markets and type of moves, do the trade that makes you puke. In other words, and this is why we're in that gap, they're in that place now where you're right. Everything I look at, all the technologies I look at, oil, Canada, all of them are saying the same thing. And from an Elliott wave perspective, you've seen it consistently. The E wave has been picking a top for the last, or bottom on oil for the last whatever. And they're right, but there's no good being right in the wrong market if you're going to put some money on it, and because you're going to lose it. And that's where other things take over, and it's not experience. I think it's experience of understanding sentiment and experience of using certain other things. But that's what Paul Tudor Jones is alluding to. It's understanding. If you can get it, you'll make far more money, far quicker by picking a top and the violent reversals, because markets tend to reverse more strongly than they actually do on the blowout, even though, however aggressive the blowout is. Euro Swiss, you just need to remember that one. I always remember that one because I mentioned the other day as I was trying to buy the damn thing, I was getting so much abuse from people, and overt, nasty abuse about how stupid and wrong I was. And we're not quite there yet in oil. Everyone's saying the same thing. Oh, I think it's bottomed, etc., etc. Anyway, back to the point. Is he saying that's if you pick it right, if you get it right, then there's a justification for bucking the trend. But often it's he also says, since I've got this in my mood, there's no trading classroom or otherwise can prepare you for trading the last third. I mean, he's talking about the last third. I would take issue with that. But the last tail end of a market, the end of a bull market or a bear market. And that's where we are, and that's my point. I think there's almost a consensus, that this is the tail end, but it can go significantly lower, and that's where price action and history comes so important, because if you can't rely on your standard technology, whatever it is, RSIs, you'd be killed by now. Or even your 8-wave, 5-wave trend sequences that are over, you're still trying to use those and you're not making money and you're getting killed on it, then you have to find something else that works. And I think this is this is such a powerful and obvious argument, is well, what does it do? How does oil bottom? How does Canada top? Are there any instances where we've been this before? I'm fed up trying to fade it and lose money. Is there a way? In fact, I can make money by going with it. This is what I always end up doing. I think it's a personal failure. I will go with the blowout, and because it gets me three things. One, it gets me money. Secondly, it gets me a rhythm. But also, therefore, it gets me so close to the market that I'm watching people, looking at people, hearing them fade it, and I'm actually the other way. It gives me the precise timing. And that's what I'm seeing now, is you go in, Canada, hell, 141.77. That was a bit of a surprise, yeah. I mean, technically, there are many reasons why it shouldn't have done, but it did. And that's exactly what it did previously. And that's really what wanted to show you, and I know you guys know what hymn sheet I'm coming off, but everyone understands, don't they, that dollar Canada and oil have a close relationship, don't they?
Yes.
Yeah? Being a net exporter, there are obvious reasons why. Longer term, you can see there are times when it will be either the stock market or dollar generally, or maybe something oil related that doesn't arguably have a knock-on impact, but they're pretty close charts. And if from a simple tech.
I just like to say, Mark Chandler did a correlation study on both CAD and oil, and U.S. and CAD interest rates, and the interest rates were pretty good also. A really good correlation.
He found a high correlation, yeah, strong correlation.
Yeah, a higher correlation with the interest rates than he did with the oil. But I think what a lot of people are not understanding today is that a lot of these markets are not who's following who or this or that. It's more of a mirror, in my opinion. So or like a shadow. So. I mean, can you say your shadow's following you? No, it's just a thing that's there that's not really significant to the main thing, and you get lost in these semantic conversations about which is the leading indicator, which is the leading thing, and I think that's a really a dead end road to get to. But I just wanted to mention that study that he did was pretty good.
Well, cool. I mean, I was going to struggle if you found the opposite, because I probably wouldn't actually, because I mean, this is kind of a bit of a nuance to your point, Chris, about the shadow. Because sometimes you can be a Peter Pan and the shadow will disappear. I mean, maybe the sun comes out because you're with
Right,
Blake.
right. Yeah.
God forbid, let's really pile the analogies on. But it'll come in and out, and that's why it's difficult. And I was looking at something today with someone else, DAX and oil, because a lot of people were throwing out charts yesterday about the S&P and the oil. They were ticking together. But in actual fact, it's the DAX has a closer relationship to oil as well. And that's really weird because just looking at it, you think, well, it's obvious. Everything is revolving around oil. Yeah, I mean,
That's the point. That's the point, Ed. I was just exactly what you're just saying about the DAX. It is honestly, there's so few actual strings that you would say, oil and the DAX, but
no, you wouldn't know. I mean, there's not exactly bursting with German oil companies in the DAX, so that's no. Well,
exactly.
Look at this.
Exactly my point. So I'm glad you picked up on that. That's great.
Yeah, but I mean, to take that 1 point further, and then you look at a chart. It actually looks. I mean, and it's sometimes, and I tweeted it. If anyone wants to pick it up, this morning when I did a DAX update, because but it's really interesting because it looks at times like the DAX is leading oil, which is even harder intuitively to grasp. Why the heck? You could say, well, it's global demand represented by German demand represented by the DAX. No brainer. So as the oil price goes down, it's a reflection of risk aversion. It's a reflection of economic aversion, if you like. People don't want to spend money because they're worried, and therefore that has a bad impact. You come up with all this bullshit, for want of a better word, and you come up with all these arguments. But then it looks like the German DAX might be a day ahead of oil. Well, what's that about? And other times it's been oil's lead. So you're right. So if it's too variable, then you can't use it because, well, you can. Just be aware that it's going to do the same thing. And obviously, by extension, the euro's had a close relationship with oil, and sometimes it looks like one's leading the other. And the truth is, one is leading the other because, again, oil has a big impact. And that's, I really think the story of 2016 is going to be about oil both ways. And I think the argument, not that I'm a great fan of deductive reasoning, but the argument is going to work both ways. There's people poo-pooing at those who said that oil price would go down, would be good for the world because we all have more money to spend, and that would cause stimulus and risk assets going up. And yet the result has been oil price goes down and the risk assets go down. And why is that? Well, because everyone's worried, and they're worried particularly because China has a close relationship, particularly to China's an investor overseas, has a knock-on effect, so everyone is worried. What happens? I think this is I'm not really want to go into this point. It's a substitution effect that 6 months down the line, as it comes, once it finds its low, if and when it finds its low, it comes back. Then the traditional argument that it's a stimulus will work. That it's in suspension because fear is suspending it. But anyway, that's beside the point. What do I want to do? Right, so let's go back. And you're saying, well, is there a guide? How silly can we be? Where is oil going and why? And technically, there's a very, very close match. Now, those people, particularly subscribers who follow me, will know that I have been working off 1 year on so many markets, and I don't profess really to understand why there's 2015-2016 has a very, very strong match with 1998-1999. I got no idea really why, except there are a few little coincidences there. One is, curiously, we've just started, the euro's just been born from a price action point of view, which is kind of cool and weird. But the other thing, and where there are strong analogies, is 1998 was the Asian crisis. Why? And the oil price, let's go to... let me show you something that shows Canada where oil. If I've got it here, I just threw some charts in. I wasn't going to do. Yeah, this looks like it. Okay, this is oil and this is dollar Canada. 1996 to 1999, both oil and Canada at the bottom and current. Well, these are probably a little bit out of date. Yeah, they are out of date. But the price action is very, very similar. So it begs the question, well, oil was going down and dollar Canada was going up. They have that strong relationship. That's no surprise. But why? Well, 1998 was a year of the famous Asian crisis. And why was that the case? Now, there's actually, I've looked a lot into this because partly out of curiosity, but partly also as a lead to what might happen. Why was the oil price going down in 1998? And it was directly on the back of Asian crisis and the fear about lower demand. And lo and behold, we got China driving or helping to drive the oil price low. So there's some very strong analogies there. And as to why the oil price came back, well, presumably it's because everything was sorted. No, it wasn't. And those people argue. What I should say is the type of thing I'm showing you here, where price action repeats itself, where history does repeat itself, is essentially fractals. All a fractal is price action that can be repeated, and obviously price action can be repeated. The question then, the argument, the economists will always argue, and many people will argue this is voodoo because the circumstance is always different. And I would want to agree with that, because I'm not a great person who believes in predeterminism or mystic world or whatever. But I would argue twofold is, one, the causes, the nature of the causes that affect the supply and demand of any given instrument are often very similar, if not constant. And also the details are very similar, as I just alluded to. 1998, 1999, Asian crisis, hello, and the same type of price action. And the most powerful argument is that it works. Yeah. Look here. I mean, I'm just bottom of this is an old chart going back. It's just saying we were going to do this in dollar Canada. You go back in some of the. Let's see what I don't want to go on. There's no point. But just take it from me. This is this works.
Ed.
Yeah.
Can I ask you a question?
Is it not personal?
No, regarding this. I mentioned yesterday that I was hoping that you could give an answer, because I have an answer, but I don't want to, I was an add-on guest here, so I just want to ask you a leading question. Can we break this down and go into so look, we look at other oil bottoms, and we say, okay, what happens typically at a bottom? And can we break that down to like a 60-minute chart, and then kind of look for those kind of those kinds of activities?
But there's actually something I'm going to I wanted to show you here. Yeah, absolutely. I mean, what I do is, this is how, without giving too much away, how I approach fractals is conceptually, always conceptually. You see a lot of people doing some really good work on fractals and some doing some very poor work on fractals, and they tend to use price action. Now, there's no reason not to, and there's plenty of price action, particularly with algos out there, repeats themselves over and over again. But when you're doing fractal analysis or analogy analysis, whatever you want to call it like this, or even standard economic analysis, because most economists use comparatives as well, look back and say what happened last time, is look what happened last time and look and spot the differences. Look at why there might be differences, but also look at the surrogates, because we're actually, and that's the point I'm coming to, 1998, where is it? Tommy, do you, and I didn't expect a right or wrong answer on this, do you recognize this chart? This is oil. 28, this is the bottom, chaps. You recognize that chart?
Yeah.
Is that a current oil chart? My first glance, I would say no. That looks like a wedge, and it doesn't feel like a wedge at the moment. It feels like it's falling apart, although it isn't really.
Hey, Ed, you just went to speaker. I'm not sure what happened to your microphone.
I just went on to.
Yeah, it's like your microphone. Your microphone switched off, and we can hear you in your computer mic.
Or you went back into the closet.
Yes.
I think that was a quality control.
There you go. It's good. We're good.
Yeah, whenever I start talking rubbish, it just goes to that, so you can't hear me. I'm surprised it didn't do it before, quite frankly. Hey, look at this. Well, look at this chart. Chris, you got a spare couple of months?
Yeah, sure. I got time to blow. I'm still young.
Yeah, right, here we go. This is an oil chart from 1860.
Wow.
I borrow this from someone who's not showing up on the chart? Apologies, he's there. Where is it? Yeah, traderandhisshadow.com. It's a cool chart. I love charts like this because this is if you like, the database from which many ideas can stem. But it's you know, how does oil top and bottom? You think if you stand back and look at a chart like this, well, quite clearly they're all spikes, but they're not really. A lot of them actually are rounded gradual bottoms. Let's go back to, let me lead into the point, one of the points I was going to make. 1998. Here we go. Right, that's 1998 compared to now. It's similar? Conceptually, I see a similarity. I can see this rallying strongly, messing around, new low. Rallying strongly, messing around, new low. This is an early wave three-legged rally. I don't think that's a three-legged rally, but it rallies strongly, back close up to levels, and then fades again. Look, it's got a hook. This is quite similar. Hooked, price action, and then gradual. What is similar, though, is this decline. These two declines are pretty similar, and this is a pig. Look at that, baby. You see that? So I mean, if I were to take, I would take. Look, straight away. To me, this looks pretty clear. If it's going to follow this price action, which I'm not sure it will, but it's almost done it now, actually.
Hey, Ed, can I throw another question at you?
Back up there, come to marginal new lows. So the indicator that we're bottoming would be something violent. Yeah, well, then that's no surprise. So it's going to rally $8 and then go back down $9, and then, but you kind of, that's useful in itself. But anyway, let me, Chris.
Hey, Ed, yeah, I just want to ask you another quick question. Something that I think a lot of people might miss, if it's so obvious, but you gotta kind of verbalize it. The difference between the market in 1998 and now is huge in terms of structure, because what used to take 1 month to unfold now unfolds in 3 days, and that's just the nature of how fast information moves and how
absolutely.
How much money is sloshing around.
Okay, let me make 3 points, and
and by the way, I didn't do any studies on that. That was just an analogy. 1 month, 3 days. I don't know what it actually is. It could be.
Yeah, but it's what you outlined is a very, very valid approach. If you find a conceptual link, then explore it, and then look at 3 months, but also bring it down to the short term. Don't just go, well, it looks like it, or force it to look like it, because you'll lose your shirt doing that. But look at, see if it does fit, and if it doesn't, then it doesn't. Yeah. But also look at the surrogates. Now this is. Let me finish with one chart. I'm going to show you now. Gold. Yeah. Gold 1998. Gold. Yeah. 1998. Bottom chart is oil. Current. Oil is following gold 1998. It's not following oil. That's cool. That's worth knowing. Anyway, that's beside the point. So that's the point I was going to end up with, so I can remember to show you. I'm all over the shop here. Yeah, the point, Chris, about how markets change, and they do very much change. But sometimes you could argue that what the Eurodollar is typical of doing.
What I mean is the structural nature of the market's changed. Whereas what used to take a month to unfold, okay, the speed of information and the amount of money and leverage sloshing around is just far greater than it was then.
And to support your point, these 3 charts, this is the chart I was looking for, it's gold, and all 1997, 2001, it's gold, obviously gold. Oil is white, and Canada's red, obviously. Right, what do you notice there? You notice something? It's actually Canada moves first. Canada bottoms first, then oil, and then gold. Well, but there is a huge difference in time. It is a year's difference between Canada bottoming and gold, and it is probably close to, I think, in fact, it is September, October, 4 months between Canada and oil. Now that's your point, is we are moving in sync. they're moving in sync now, whereas in 1998 they were moving differently. And for the reasons you give, I think people discount the way people trade. They discount time much quicker now. Whereas before the fund manager would report once a year, yes he did, or once a quarter. Now he gets a tap on the shoulder, not even once a day. He has to think much more shorter term. And when you think those terms, and when the pressures are shorter term, then it brings markets closer, because you start looking at things shorter term and acting and trading shorter term. It just brings things together. In an increasingly global world with the internet, blah, 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 your point, very valid. So they are moving far more together. Doesn't mean that you can't match the price action. But you can probably see on this chart alone how gold is very similar to oil, but it was later, and now oil seems to be moving in sync with gold. So let's bring that back to...
Can I ask you a question about fractals, Ed? Which I think it's for people that attempt to do fractals, and I'm not a fractal person, I don't, and it's not that's not my wheelhouse of things that I'd want to do. But I guess I got a question from like just looking at your analysis. Can you take like let's say you're looking at a chart of crude oil and you're looking from 1999 to 2002, right?
Yeah.
And you look at that same price action and you go, I see similar price action in the S&P, an hourly chart that gives you the same amount of time intervals. Do you ever do that? You know what I mean? So you're not
same amount. Oh, you mean it's the same chart, yeah?
Yeah. So you're basically saying
all the time. Yeah.
Okay.
I have a photo. This is how I This is why I do what I do. You play to your strengths. I have a photographic memory. I look at a chart and I just say, that's the S&P 19 whatever, and it may be on a 5. I did it yesterday. Was it yesterday? The DAX. Yeah, when the DAX rallied off 96.27, the Monday low, the overnight low, it just basically repeated the entire September-October S&P rally.
Okay, so you do that because
I do that.
Okay. All right.
And that is a dangerous stuff. That's price action analogies fractals where if they work, they're going to die at some point. Remember that fractal doesn't go on forever. Just beware that it's a weak, when there's no logical or conceptual power behind it, then it's going to be a weaker form. I would argue a weaker form.
That makes a lot of sense. And the reason why I can't do fractals is because my wife says I would have the opposite of a photographic memory. Okay, all right, I got it. I got you.
Maybe you don't, but you can do it. Where you can do it, I would actually love to give you a course, because you would be quite different in your style, but you'd be very, very powerful doing this approach because you're very good at correlations. And then a lot of fractals I do are based on correlations. For the obvious famous one last year, which was possibly, or going back before that, 2014, possibly one of the biggest trades over a 6-month period, was oil and gold. But they're correlated, but they weren't, because they were out by about 70 days. And when you try doing correlation, the correlation says there's no correlation here. Well, actually there is. Just shift it 70 days and bang. So where you could be really and would be good is using the correlations logic to understand why. You ask the question why, and this is what people say it's food. It's not. It's the form of analysis we all do. The difference, all that fractal analysis is doing, is putting price action on an argument. Okay, so you say that oil is going down to 2 because of X, Y, and Z. Well, these circumstances X, Y, and Z existed 50 years ago. What did the chart do 50 years ago? Wow, you're right. No, sorry, you're wrong. And that's all it is. So it's saying, how do we know how, and this applies to every form of analysis out there, whatever, quantitative, qualitative, anything, is how do we know, why do we believe it's going to happen in the future? Because it happened in the past, yeah?
That makes a lot of sense. So
we base our entire lives on that logic, so it's why shouldn't analysis of markets, you can call it what you like, be based on the fact that this is what happened before X, Y, and Z, and therefore there's a chance it might do something similar, but this time it's got a bit of Y, it's got a bit of B thrown in because of X, Y, and Z. Well, actually, this B is closer to gold. Let's look at gold at that same period, and whack, it is the exact match. You know, it's all logic, Blake.
Interesting. Yeah, that's good. It's great. And that's what I think.
It
That's
is
what
not. I use this phrase to no one, but it's like revolutionary old to traditionally new. There's no rocket science, no great inventions coming here. It's just restating the bloody obvious. I'm sorry.
Yeah.
You've got me
No,
off on a rant now.
but that's what differentiates what you do versus what I've seen other people do. And when you have people say, you know, I don't even want to hear fractal analysis. It doesn't make any sense to me, and it doesn't work. But I think what you're saying makes complete sense. You're looking at logic versus.
Why doesn't correlation analysis work? Well, because I tried it and I lost money. Why doesn't fractal analysis work? Because I tried it and lost money. You know, and you try it once, and you try, and this is unfortunate thing about something like this, is you try and how many people picked a 1929 crash on the way up in the bull market and said, look, it's identical, and how many people therefore sold, and how many people lost it, and how many people therefore thought fractal analysis and analogies are bollocks? Well, quite frankly, the people showing you that chart were getting it wrong. I mean, you know, it's not the fault of the fractal analysis, it's the fault of the people trying to do it, and that's the danger. I mean, it's the same with trading. Be disciplined, be logical, and be objective. And if it doesn't match, it doesn't match. Yeah.
Yeah.
Can I bring something? Can I bring something into this?
Please do.
Yes.
Yeah. Before I go off on completely.
No. Bring it a little bit around to the traders listening, and that's why as a teacher, when I used to teach more actively. I would tell people to really try to find what their strengths are, because for example, I would not recommend to Blake, you know, not that he needs my recommendation, I'm just using it as an example. I would not recommend to Blake, hey, listen, take a year and a half, 2 years, and get into fractals, because this is really going to be the backbone of your trading strategy, your trading career. I think each trader needs to really take a look at himself and identify what methodology or what system he's going to use. And I'll tell you this as a fact. I know it. Look, I try to share my methodology with Ed. 5 minutes in, his eyes glaze over. He's looking at it. He's trying to figure out how to get the hell out of there.
I was drunk at the time, and Chris brought his girlfriend along, and they just...
No, he's not interested in my strategy, and you know why? Because his mind and his perceptions don't work that way. Number one. Number two, as a professional trader who's had some success, he doesn't want to mess with his recipe. He's got a recipe. Okay. Now, his recipe and my recipe are completely different, and Blake's is completely different than both of ours. And I think that's another thing you guys have to know. Same thing with Blake. If I go into listen, I know for sure he's not even paying attention. Why? Now I'm not saying he's being rude. I'm saying that for him, he doesn't need to take anything away from that strategy, because look, he's been doing this long enough. He's got his system honed. Okay. So, and it's the same thing for me. I could try to use fractals. I could try to use Blake's method, but it just it doesn't work for me. I've learned trading, with a handicap. Okay, so now I'm that baseball player that's out there playing with a handicap. I'm limping all over the field, but I got to tell you, it works for me. So I'm not about to go get an operation, change my whole leg, and go through 3 years of just so I can run straight. No, I'm working, I'm playing, and I'm playing the game correctly. And I think most traders need to understand that they have to find out the type of animal they are. Not everybody's a giraffe, not everybody's a lion, and not everybody's an alligator. And I find comfort when Blake and Ed get to the same point I am at, like we were talking about oil and Wittick today, but I can tell you for sure all three of us got there in a different way.
This is true. And no, so back to, and Chris, those are great points too, because a lot of analysis is really using confirmation. Like I have a great respect for what the both of you do, and so when you guys are looking in the opposite direction that I am, that usually is very concerning to me, and I have to go, okay, well, why are they seeing whatever they're seeing, and what is their justification for it, and it will and can impact the decisions that I make as a trader. So go
there's a
ahead.
lovely just a story. When someone says with respect, it actually means they disagree. If someone
But
says
that is true.
with much respect means they disagree strongly, and if they ever say with the greatest of respect, they're actually saying you're talking bollocks.
but if I
didn't know that. I didn't know that. That's a good one. I like that.
I apologize for the language.
No, that's funny. That's funny though. But if I say, I respect what you do, it's because I disagree with your opinion, because you're looking at something and I'm not seeing it, and I happen to be trading the opposite direction. However,
I actually, the reason I thought of that is not because you were doing that. It's actually you weren't doing that. You were being quite sincere and genuine. So
okay.
I would agree. I would agree. When you say something, or Chris says something, I listen. When a lot of people, I always say this: if you give me, I don't want your opinion. I just want to know. Give me the evidence for your opinion. That's what I'm interested in. And then when you guys give me evidence, then I definitely listen. That's a really cool chart. Can you see it?
Yeah, that is a really, really cool chart. So
it puts perspective on things, doesn't it? It's like for the last 160 years, oil's been a trading range, which in actual fact, there's a really good book on dollar Canada. It was commissioned by the Bank of Canada, and his name's James, and I've forgotten what it is. And that book's got some really cool charts, and it shows that dollar Canada is just a range. And do you know what the equilibrium point of dollar Canada is over a 200-year period?
$1.30.
Oh, you don't need to think really hard about this one. Dollar Canada's parity point is the equilibrium point. Oh, there's a point.
Really? Wow.
Parity. Everything goes up and down and around parity. It's been down to 72 and it's been up to whatever, and it just finds its way back to parity, which is not really surprising, because I guess probably grateful for there'd be a bunch of grateful Canadians, because if it was one-way street, it probably mean that by now Canada would have been invaded and taken over by the Americans. So it's probably a good thing that it's.
You got a lot of Canadians listening. Don't go there, Ed.
Abraham Lincoln, wasn't there? Gosh, let's not go down that one. But anyway, let's bring it back to.
Sounds good, because when I look at your crude charts, and let me just tell you what I've extracted from just looking at your charts. You see the Canadian actually spiking up further from where it is, and crude going a little bit lower before a reversal. And let me just make sure that's what I'm extracting from the charts that I've seen. In
a nutshell, basically this is a blowout, and that's when you throw. And this is a point about the Paul Tudor Jones quote.
Okay.
You can blow. You can don't whatever you do. Be surprised if it does something silly, because for me, it's now achieved everything I wanted it to. Yeah, and I now have puts. But the reason I'm not in the cash market is because I'm strongly aware that sentiment isn't right. There's two ways sentiments can work in a top and a bottom. If you get the textbook, we all know that people get euphoric and they get long, and they get silly. Yeah, that's how they work, tops and bottoms. But in fact, a lot of the time, half the time, they don't work that way. What actually happens? That's a hard top, which I think this is quite clearly proving to be a hard top. So I would expect this to get silly. But something like oil could actually work something differently, because what happens in dollar yen, the famous example of this, you might get a momentary spike, but actually what happens is it just does nothing. It goes sideways in a range, and people kind of get bored of it, and slowly but surely it turns back up. And what people do is, because they're so used to the level of volatility in those ranges, they fade it, they sell it. So as it starts rallying, or in this case, let's use oil as the example, as it starts rallying, they don't believe it. They didn't buy the bottom, they haven't got it, so all they can do is sell it. So as it goes higher and higher, this is dollar yen from 78 up to 100 plus, they start selling it, and all they end up doing is selling the entire way up, and that's why it ramps into a bull market. So when you look for a bottom or a top, yes, you can look for euphoria, but sometimes It doesn't need to be. But in this instance, my point I made here is I actually think there's a risk. Oil will do that, and dollar Canada's in a blowout. Quite clearly, dollar Canada's in a blowout, so it can do something silly. Can it do something silly and oil not do something silly? It doesn't feel that way. Yesterday, Elaine, this is my problem. I have a precise, and I've had a very precise 144.80 target on dollar Canada. Sounds ridiculous, but it sounded even more ridiculous around 138. When it's basically and when it broke through 134.60, it pointed 144.80. It sounds stupid, but actually at 143.15 and now 142.10, 15, whatever, it doesn't sound so stupid. So it's in play. And 141.80 yesterday, it needs to hold 141.80. When it did, to be precise, what it did back in 1998, it moved 5%, 4.6% in 9 days. It then moved 5% in 11 days. It's already about 2 days behind from 138. It's also already moving slower. Yesterday, all right, so what does this mean for oil? You know, I actually don't know. I'm looking for the conditions to be right. I have the same thing on dollar Canada. All my little wave structures all tell me that oil is over. It can rally now. But I also see everyone trying to pick, not everyone, but lots of people picking a bottom. Sure. I do see the right sentiment associated, as mentioned, about jokes. I've mentioned also on Twitter about pundits, everyone saying, you know, when they say it's getting much lower, what tends to happen, you get an immediate reverse when you buy the next new low. That's typically what happens. We're at the next new low. So from a sentiment point of view, it's in a position to turn. Will it turn? And that's the problem. Yesterday, for every tick dollar Canada did, and I'm taking 140. If everything says that 144.80 is right on dollar Canada, which I find hard to believe, but so far this baby is worth. If it is right, then what does that mean for the oil price? Yesterday, oil was moving 2 points for every dollar Canada point. That would put it at 28.30. What? And that would put oil at 28.30 as a bottom. Do I see it at 28.30?
Yeah.
I don't know. I honestly don't know. So that is, I'm waiting for confirmation or something stupid before I can go in. I have my strategy on oil and Canada. I'm already in on options, but I can't go in cash because I find about oil, it rarely gives you the right risk return. It's too volatile, too violent. I find for my style of trading to trade it all the time. So that's why I dip in and dip out. But I'm already in on options, but I'm also looking for a stupid price. Along dollar Canada, 144.80, you can think, well, at least one person as well will be buying oil. It'll be me. But going back to the point I wanted to finish with is gold, 1998. Do you see the closeness of this price action?
Yes.
It's much closer. Gold, 1998, is much closer. And do you see the wedge? You know, gold's in a wedge. Everyone knows gold's in a wedge. Gold's been in a wedge for well over a year. You see the price action of gold is quite clearly wedge-like, and then look at the last leg. You see it?
Yeah, and that's it. Blue is the current, correct?
Oil. Blue is the current oil price.
Okay.
And gold is the so here, yeah. I mean, and that says so. It's one of these things. I'm sure your webinars have loads of disclaimers wrapped all over them, but it's beware. You're playing with something that's violent and that's moving big points. And you may not think oil can go to 25. It's stupid. But if you're long now and it's at 25, you're 7.5 points out. You're 25%. You're 30% out. That's a lot of money.
You know what? You know what? I have the harder time believing, and I know Chris would disagree with me. Are you still there?
Yes, I'm here.
I don't believe, and this is our listeners that are tuned in right now, our normal listeners. They've heard me say this a lot over the last year and a half. I really think the crude, the price pricing crude. I think crude is as a asset class is somewhat broken. I think it's it's just not going to be utilized as much in years to come. I think there could be obviously a short squeeze in crude. I could see crude going from 30 to 40, which would be a nice nice increase in value. I don't see crude oil back at 50, 60, $70 anymore. It's not. I think crude is going to be an asset class just kind of shunned.
If you want the economics of oil, could argue against the the price you gave 50, 60, because let's say. I think you're right. I think what you're actually describing, what we're also seeing, is rather than the end of oil as an economic resource, we're actually looking at a supply. I've made hundreds of times, and with you guys, about post-deflationary bubbles.
Yeah.
The oil bubble burst. You've seen it in Nikkei back in the late 80s. Funny that. Hello. I'm just doing that because we're on a similar path on those babies.
Yep.
Where gold, you've seen it. It goes lower, but it dies. It just dies. And so what you're actually describing or giving vent to is a market that's dead. Is post-bubble. So it's another more perhaps topical, more recent example is Bitcoin. Yeah. Is Bitcoin going to go back to the highs? No, not a chance. Not unless it's going to be used, and probably will never even get there, even if it became regular currency. And it's the same thing. So, but the economics of oil this is why oil. Go back to that. Where's that real chart? Help me here. This one. Yeah. Why does that chart work? Well, quite simply. There's a price of getting oil out of the ground. If the price is too low, it stays in the ground. So the price has to go back up. If they're not producing the oil, there's less supply, and the price goes back up, and the net result is getting into its own spiral, goes to the top. Well, everyone is producing so much oil, even the donkeys are delivering the oil. There's so much oil, and it forces the price back down. That's why you get that range chart, and that's why. It doesn't matter if oil dies as an asset class; it will rally and then it will fall because of that simple economic argument.
Point take.
Could I say something simple?
Yeah, please.
I think oil is a reflection of the rate of economic growth, and gold is a reflection of interest rates. So the two of them taken together will give you an idea where interest rate. For a long time, everybody thought interest rates were going to stay negative, and that the world was coming to an end, and that's why gold shot up to where it was.
So actually, what you're saying, Chris, is it's really an interesting point. What, by implication, is the difference between gold. There's a time lag between gold and oil, and it's an inflationary lag. It's the time that inflation takes to come into the system.
Right, and one is connected to the rate of growth, of economic growth, and the other is connected to the interest rate, in my expectations of interest rate. But that's just a simple way of looking at it, and I have to, I could be wrong. There could be a quant out there that tells me I'm more wet, but as a layman, that's the way I like to look at it, and I think it simplifies it really nice.
And so there's one other thing I guess I'd like to maybe discuss regarding crude oil and where we're currently at and the economy. A lot of people are like, well, gosh, you're not seeing this tailwind and like the transports from a weaker crude price. And my opinion about where crude is and like gas prices, where they're at, the consumer right now, at least the American consumer, and I'm sure the European consumers and Asian consumers to a certain extent, are very comfortable where prices are. So if you talk about the economy and what could really push the economy or tip the economy into maybe a recession, I think as if crude really stages a recovery. If we bounce to $40 to $45 a barrel, and you see gas prices really spike up, I think that's going to be a very, very big very big headwind to to the economy, because a lot of people, we've had this discussion earlier this morning before you guys came on about the economy going into a recession versus, the stock market is not the economy, just like it wasn't the stock market wasn't the economy on the way up. People are like, oh my God, we're almost tipped into a recession. Why does the stock market keep going up? Because the stock market is not the economy. And as the stock market is coming down, I don't think the economy is going to, really be a lot different as stocks, if stocks continue to go down. I think it's just more of a reflection of higher rates and a monetary policy. But if crude rallies from current prices and we really see a substantial recovery in crude prices, I think that is going to put a lot of, like I said, it's going to give a lot of headwinds towards the global economy. I think people are getting really comfortable with these prices.
I would agree entirely with that. I mentioned it the other day. I think an oil rally, if and when it happens, is going to be the trigger for an economic pickup. Almost, well, you could use the same, the arguments as you've just done about the arguments in reverse. But I think, and also, I think a spike down. This spike down could be the trigger that reverses oil. So this is maybe a bit bizarre, taking it one step too far, maybe. But again, choosing Paul Tudor Jones says he believes strongly that markets price action moves before fundamentals. A spike down in oil gets silly. The market gets short. That then causes oil to come back up. That could be the trigger for a much larger oil rally as it starts feeding, which could be the trigger for economic stimulus. Do you see what I'm? So in some ways, the market, and this is almost an argument against, in favor of speculation. Let the speculators have their way, because they'll actually help trigger something here. And this is the. Let me make a point actually about, there's a really good study. I did some work on 1998. There's a book, a thing from, actually it's Oxford University, my alma mater. The Energy Institute there did a study on 1998 and what they thought was the reasons why the oil market recovered. And therefore, I was looking at the reasons why. In other words, what would make it recover now? Well, certainly the causes were similar. I mentioned about the Asian crisis and deflation and lower demand. For 1998, and the reason though in 1998 why the prices came back was OPEC. In February of 1998, OPEC came and got together again and said we're going to cut production. No one believed them. They said, well, yeah, you say that, but you keep cheating, you're not going to do it. So what happened for 4, 5, 6 months? It would rally. It rallies. They're going to do it. They're going to whack back down, and then eventually. They were able to do it, and people were able to, they started feeding the rally, and it fed on itself, and then it, rally 1999 was a bull market on oil. Cool. Let's hope that happens, or let's see if it does happen. But the difference there, the point I want to make, and it goes back to Chris's point or general point that people make about the difference in histories and therefore different price action. When you got something like OPEC in the way, it does distort, but not necessarily the way you think. And that's the same with central banks. So classically, anyone who traded in foreign exchange in the 1990s will know central banks came in. Your first blow, you fade a central bank. It may move 200 points, then you fade it because they fail. Yeah. So you go back in the 1980s, and I think the opposite applied. But in the 1990s, they basically were failing consistently. And the same thing with something like OPEC. What happened for 6 months, if no people didn't believe it, pushed the price down. So that's possibly why you got such a sharp recovery in 99, and why oil and Canada and gold were out of sync, because OPEC was in the way. Now, we don't have an OPEC yet. We don't have the fundamental reason for a turn in oil, which could be an argument to stay away, if you like. But we could have it in the background, or maybe, maybe, I don't know what's going to happen. Maybe oil, the Saudis are going to become the biggest frackers out there. There's talk of them doing that, so why not? But for whatever reason, you just got to keep an eye on the differences and why 98 was slow and why they've all come together this time. Maybe because we don't have OPEC, and actually the reasons for the market reversing could be the market itself.
Yeah. Well, hey, Ed, and Chris, we've got like about a minute left. I want to mention a couple of things. First of all, I want to thank you both for being here. Ed, you're sharing your longer-term thoughts and even your near-term thoughts with crude and the Canadian dollar. Fascinating. And I myself, I'm looking. I've been playing the dollar Canadian on the long side for a long time, and I'm actually short the dollar Canadian. I have some exposure. I wouldn't mind getting more exposure. I'm actually looking for a turn like you. I'm hoping we don't spike up to 144, but as your charts have pointed out, it is possible.
Yeah, no, Blake, I should say that, and I'm sure all your people listen to will know that we were probably, I'm blowing our trumpets here, we were about the three lone voices of dollar Canada below 100, down at 96 and 91, calling for 134.60 actually was my target, but we were all there together looking for a major bull market. And
yes.
So
I just want to reiterate, yeah, that there were very few of us, and the three of us I can vividly remember were some of the very few people calling for that move. And so now, you see a big change of tune between what we're all looking for. I also want to mention, Chris, you're going to be doing a webinar yourself on price action, intraday price action on crude and the Canadian here in the next couple of weeks. Is that right?
Yeah, but not only intraday. I'm going to look at the monthly, the weekly. What I just want to say about that is that some of the things that I've been seeing on Twitter and some of the directions people are going are making it overly complicated. It's in the chart, it's in the candles, and I just want to give a nice little webinar based on that. And
okay. Some
people had asked about it, and I said if I could get a large enough group, I'd do it. So
okay.
We're about halfway there.
Okay, so follow Chris on Twitter. He'll be giving more information on that webinar. Ed, Chris, I want to thank you both for being here today. I think Kip's probably live and logged in. Hey, Kip, how you doing?
Hey, good. Good morning. I enjoyed listening. I want to say something real quick too that reiterate what Chris said. We all see things a little bit differently in charts and how we interpret information. And the best thing you can do is take bits and pieces from different people and meld it into your own personal trading style, because all of our brains are wired a little bit differently. We all see things a little bit differently, and I'll never be able to trade like Blake trades Forex because he's got his system, and I won't be able to repeat it, but I can get as close as possible by working my own methodologies and finding what works best for me. And I just want to agree with what he said.
Yeah, it's great suggestion and opinion. So,
Thanks, Kip.
Go ahead.
And, thanks, Kip, and hi, Kip.
Hey, well, good morning. And Ed, good morning. Enjoyed listening to you as well. Thank you.
All right. Well, Ed and Chris, thank you guys so much for being here. We appreciate you. And remember, follow Ed Matz on Twitter. He is Ed Matz on Twitter, and Chris is Brazil61. The guys are full of great information, and I love having both of you on there. So thank you both very much.
You're welcome. Okay. And let the crude be with you, yeah?
All right. And Kip, it's all yours, buddy.
All right. Thanks. Thanks, guys.
Thanks, everyone.